Guys, Trump just officially reset your money. If you have US dollars, stocks, bonds, really any assets in the US economy, this is a video that you're going to need to watch. The US dollar just broke a critical support level that's held since 2008. And when you combine that with the Federal Reserve signaling 3 more rate cuts while the new administration threatens 100% tariffs on our allies, we could be looking at the biggest monetary shift in decades. And 90% of investors have absolutely no idea it's coming. So today's video, we're going to break down exactly what you need to know and how you can use this to your advantage, because there's going to be a lot of people that this becomes a shock, people that are going to be left behind. And then there's going to be a lot of people that were prepared for this, people that are going to benefit massive. We're going to break all this down for you with the timestamps down below. And the only thing I ask in return for all the work that goes into making a video like this is that you hit this like button and don't forget to subscribe. Every time you do that, YouTube goes and pushes this video out to more people, which helps us prepare more people for this incredible year. And if you want access to our full research and daily stock ideas, you can try our premium community for just $25 at stockscommunity.com for 7 days. If you want the full transcript of this video and others like it, sign up for our free newsletter at free.stockscommunity.com in the description below. As always, if you're the one making the actual purchases, the buys and sells, you have to do your own due diligence as well. Take your time, be cautious. This is not financial advice. I'm just sharing my research and you have to make your own decision. Now, let's get into it. Wall Street knows about this. The smart money is already positioning, and I'm going to show you the exact timeline, what's breaking down, and why 2 specific assets are positioned to capture more of this capital flight than almost anything else. But here's the catch. The window closes fast, so let's break this down step by step. The US dollar just had one of its worst weeks in years. We're talking about a massive move, the kind of move you rarely see in currency markets. The dollar dropped from around 99.5 all the way down to 97.5 in just 5 trading days. That might not sound like much, but for a currency, that's absolutely massive. That's the kind of drop that makes central bankers nervous. And here's why this matters so much. The dollar has been holding a major support level going back to 2008 and 2011. We're talking about levels that have held through the financial crisis, through COVID, through everything. And now we're testing those levels again. This is the 6th time we've tested this support. And here's what you need to know about technical analysis. Every time you test a support level, it gets weaker. It's like hitting a crack in a windshield over and over. Eventually, it's going to shatter. Now, the reason this is happening is not some random market move. This is a direct result of policy decisions being made right now. You have threats of tariffs. We just went through tariff threatened on 8 European nations over Greenland. And this past weekend, there were threats of 100% tariffs if certain trade deals happen with other countries. Think about what that means. We're threatening our allies with 100% tariff. That's not negotiation, that's economic warfare. And when you do that, you're breaking the fabric of trust that holds the global financial system together. You have other countries, even our allies, saying, wait a minute, we can't be this reliant on the US dollar when they can just threaten us like this whenever they want. That's going to speed up de-dollarization. And guys, de-dollarization is not some conspiracy theory anymore. It's happening in real time. Now, is that good for gold long term? Yes. Is it good for silver? Absolutely. Is it good for Bitcoin? Probably. But for those of us holding a lot of dollars, that is not a good thing. And here's the other concerning fact. The pattern the dollar is forming right now is what we call a bear flag. That's a technical term, but what it means in plain English is that when you see this pattern, the currency is setting up for another leg down. If we break below 95 on the dollar index, you're likely going to see this accelerate dramatically. We could be looking at 89 or lower. Now, let me turn your attention to something else that's happening that confirms this story. The debt. We came into an administration where it was supposed to be all about cutting spending, getting the deficit under control, all that stuff. And you know what's happening? We're spending more money than we have ever spent before as a government. The debt is exploding, and the threats and the tariffs, all of this is eroding trust. It's eroding the willingness of other countries to buy our treasuries, to hold our debt, to keep propping up the dollar. And we're seeing this play out in bond. Despite the Fed trying to cut rates, the 10-year yield is going higher. Think about that for a second. The Fed is cutting rates, trying to make money cheaper, and yet the market is demanding higher yields on our debt. Why? Because countries are selling US Treasury. They're saying, we don't trust this anymore. We need to be compensated for the risk. Buyers of our debt are literally saying, you have this much debt. We're not sure we're going to get paid back. So we're going to demand a higher interest rate to compensate for that risk. That's what rising yields mean when the Fed is cutting rates. It means the market doesn't trust them. This is all part of a bigger web that's getting bigger and bigger. And it is ultimately going to eat away at the dollar's dominance as a reserve currency. And that will have economic implications for the US that'll last 10, 20, 30 years. Now, after a very choppy period in markets, a lot of people are wondering what's next for 2026. And here's what I'll tell you. When the world's reserve currency starts breaking down, when trust in sovereign debt starts eroding, capital has to go somewhere. And historically, we know exactly where it goes. My prediction for this year, and I want to say this as loud as possible, is that we're going to see massive volatility because of these monetary policy shifts, because of geopolitical tensions, and because of all the uncertainty that comes when the global reserve currency starts breaking down. The data suggests this year is going to be an overall uptrend for certain assets with a lot of conviction testing for others. That's going to be excellent for people positioned correctly. It's going to be great for people who understand where capital flows when trust breaks down. But it's going to be a disaster for people that just want to keep everything in dollars and traditional assets. My mission is that you're not going to be one of the people left behind. You're not going to fall for the nonsense where they want you to stay in depreciating paper assets. You need to be somebody that thinks for yourself, looks at the evidence, and understands what's actually happening. You have to understand the bigger picture. It doesn't matter how volatile things get. What matters is, are you positioning yourself appropriately for this year? That's what's going to determine whether you come out ahead or get left behind. Let's talk about what's actually happening with monetary policy, because this is critical. The Fed has shifted into cutting mode. The consensus is calling for 3 more cuts in 2026, and whoever the Fed chair is that gets appointed in May, you can bet they're going to be pushing for more cuts. There's been open criticism from the administration about rates being too high. But here's the kicker, and this is what people aren't understanding. In spite of the Fed trying to cut rates, bond yields are going higher. That's the market telling you that the Fed has lost control. That's the market saying, we don't care what you do with short-term rates. We're demanding higher yields on long-term debt because we don't trust the fundamentals. This is buyers saying, you're spending too much. Your debt is too high. Your threats are alienating allies. And we're not going to fund this at cheap rates. And that's what rising long-term yields mean in this environment. Now, speaking of capital flows, let's talk about Bitcoin for a second, because this ties into the bigger story. Bitcoin is down significantly from its high. A lot of people thought we'd bounce and go to 100K. That hasn't happened. We've fallen hard. The chart suggests we could go lower in the near term, maybe down to 84,000, maybe even 79,000. But here's what's interesting about Bitcoin in the context of what we're discussing. By the end of this decade, crypto could actually emerge as a safe haven asset. Now, I know that sounds crazy to a lot of people, but hear me out. Historically, 80 to 90% of crypto ownership has been retail driven. Institutions haven't really participated. Even today, despite all the ETFs, despite all the regulatory progress, long-term institutional ownership of Bitcoin is estimated at only around 15 to 25%. Ethereum's even lower, around 10 to 15%. Pension funds, sovereign wealth funds, big insurers, university endowments, these massive pools of capital are still barely allocated to crypto. They're structurally underinvested. And as ownership shifts from retail to institutional, behavior followed. We're already seeing early signals of this transition. The surge in bond yield, the expanding fiscal problem, the mounting sovereign debt concern. All of this is triggering rallies in alternative assets. And this is not just about inflation hedge. This is about a crisis of trust in sovereign debt and long-term monetary credibility. Now, I'm not telling you to buy Bitcoin right now. In fact, the charts suggest it's probably going lower in the near term, but the longer term thesis is something you need to understand because it's part of this bigger monetary shift that's happening. The question is, if not the dollar, if not treasury, where does capital go? And that brings us to what's actually performing right now, what's actually working in real time. Let's talk about what's happening with other currencies. The euro is breaking out. The British pound is breaking. The Canadian dollar is setting up for a major break. We're seeing currencies globally starting to strengthen against the dollar. But here's the thing. When you have de-dollarization, when you have loss of trust in the reserve currency, capital doesn't just flow to other paper currency because at the end of the day, they're all facing similar problems. They all have debt issues. They all have spending. Capital flows, hard assets. Things that can't be printed, things that governments can't create out of thin air. And that's where things get really interesting. That's where we're seeing the real action. We're about to see a massive re-rating in certain commodities, certain metals, certain stores of value that have held value for thousands of years. And I'm going to tell you exactly which one and why the setup right now is so compelling. Let's talk about what's happening globally with debt because this is the foundation of everything. Buyers of sovereign debt around the world are starting to get nervous. Balance sheets actually matter. Who would have thought, right? Japan has 240% debt to GDP. The US has 130% debt to GDP. These are unsustainable levels. This can't go on forever. And for years, people have said, oh, it doesn't matter. That doesn't matter. We can just keep borrowing forever. But the market is starting to say, actually, it does matter. We've been saying this for a while, that there are certain periods where debt doesn't seem to matter, but eventually it will. And the seeds, the breadcrumbs are being laid right here, right now. It's starting to matter. There's going to be a price to pay for all this debt, for all this spending, for the erosion of trust in the dollar globally. That price is going to be paid through inflation, through currency debasement, through loss of purchasing. What I mean by that is ultimately we could be looking at a massive shift in the global monetary system. Timing's the hardest thing. I can't tell you if this happens in a year, 5 years, 10 years, but the direction's clear. The trend is clear. And you've got to be ready for it. You've got to be positioned yourself correctly because when this shift happens, and it will happen, the people who are positioned correctly are going to preserve and grow their wealth. And the people who aren't are going to watch their purchasing power evaporate. So how do you prepare? That's exactly what we're going to talk about right now, because there are two specific assets that are screaming right now. And when I tell you what's happening with these assets, you're going to understand why smart money has been accumulating them quietly while everyone else is distracted. Let's talk about gold. Gold just had an absolutely monster move. We're talking up over 8% in a single week. Gold almost touched $5,000 an ounce. It got up to $49.91 on the futures market, $49.89 on spot. We are literally spitting distance from $5,000 gold. Think about that for a second. A few years ago, gold was trading at $1,800, $1,900. Now we're knocking on the door of $5,000. That's not random. That's not speculation. That's capital fleeing paper assets and going to hard assets. Here's what's really significant. When you look at gold compared to the S&P 500, gold is starting to dramatically outperform. There's a ratio, gold divided by the S&P, and that ratio has been climbing since February 2024. Gold's been outperforming the stock market. And that ratio just broke through a major level that's held going back to March of 2020. We're talking about a level that's been resistance for years, going back to the 1990s, and we just broke through it. That's the kind of move that catches the attention of big institutional money. And we're already seeing it. Big institutions are starting to raise their price targets on gold. Some are calling for 54, some even higher. And I genuinely think we're going there. Now, if you look at history, you can see how extreme these ratios can get. Back in 2011, during the last major gold bull market, the ratio of gold to the S&P got to a certain level. And back in 1980, during the epic gold and silver run, it got even more extreme. One share of the S&P 500 would buy you 6 or 7 ounces of gold. I think we're going back to at least the 2011 levels, probably higher. And here's why. This is not just about inflation. This is about what happens when the world's reserve currency is in crisis. This is about what happens when trust breaks down. Physical gold is where you start if you want to invest in this trend. You start with the physical metal first, and there are great ways to get exposure to it. But here's the thing. We may be at the point in the precious metals bull market where we're not going to get big correction for quite some time. This thing might just keep running because when a monetary crisis starts, when de-dollarization accelerates, gold doesn't wait around. It goes parabolic. And I think that's what we're starting to see. Gold miners are also performing well, up over 10% recently. And here's what's interesting about the miners. There's a setup that's already played out in terms of certain patterns, but I think there's going to be a re-rating. See, a lot of these analysts doing valuations of mining companies, they're using gold prices of $2,000, $2,500 in their models, but gold's at $4,900, almost $5,000, even though that might show up in the most recent quarter's earnings because gold was lower during that quarter. Nobody can deny that gold has doubled. And when gold doubled, the profits for miners don't just double, they explode because miners have fixed costs. So when the price of what they're selling doubles, their profit margins go through the roof. I think we're going to see a massive re-rating of these miners over the next 30 to 45 days as people start to understand. That's why I think there's opportunity in rotating from physical metal into select mining stock because the miners should dramatically outperform the metal itself during this phase. Well, let's talk about silver. Silver has been even more explosive than gold. We're talking up over 14% in a week. Silver closed over $101 on the futures market, got as high as $103 on the spot market. It got to $103 and closed even higher. And here's what's interesting. The spot market is more expensive than the futures market right now. That's called backwardation, and it usually means the price is going to keep going up. It means there's physical demand, real demand for the actual metal. Silver hit over $100 an ounce. Think about that. A few years ago, silver was at $18, $20, $25. Now it's over 100. That's a 4x, 5x move. And I don't think we're done. The next major target for silver, based on how these moves tend to play out, is around $130. And honestly, I don't see much resistance between here and there. Silver just broke through a major level. When silver breaks through major levels, it tends to run hard. Now, in China, silver is trading even higher. It's over $111 on the Shanghai exchange. China is paying a premium for silver. And historically, when China is willing to pay a premium for a metal, it means they see something coming. It means they're accumulating. And here's another interesting data point. The ratio of gold to silver. Recently, it was 52 ounces of silver to buy 1 ounce of gold. Now it's 49 ounces of silver. That ratio is coming down, which means silver is outperforming gold. And when you see silver outperforming gold, that's usually a sign that the precious metals bull market is entering a more explosive phase because silver is more volatile than gold. It's a smaller market. When big money starts flowing in, silver moves faster and further than gold. Here's a story I want to share. I went into a coin shop recently. I had to see for myself what the sentiment was like, what people were saying, what the demand was like. And I'll tell you, it was not what I expected. But the fact that people are starting to notice, the fact that retail is starting to come in, that's usually a sign that we're still early in this move. Physical silver funds are up over 13% recently. And just like with gold, I think silver is going to underperform the silver miners. So rotating from physical metal into select silver mining companies, I think that's going to radically outperform going forward. Silver miners are up over 13%. Here's the thing. If you look at spot silver, it did 14.5%. The miners did 13.5%. So the miners are actually slightly underperforming the metal right now. That's the catch up I'm talking about. These analysts are using silver prices of 40, 45 in their calculations for these mining companies, but we just hit over $100, even though that won't show up fully in the most recent quarter because silver averaged lower during that period. The fact is, silver has more than doubled. And just like with gold miners, price of what you're selling more than doubles and your costs don't double, your profits absolutely explode. I think we've got a lot of catch up to do in these miners, and I think it's going to be fantastic. Now, certain patterns that we've been watching in these mining stocks have already played out. The initial targets have been hit. So maybe there's more upside, maybe not from a pure pattern perspective, but I think now we have to look at this differently. We have to look at the fundamental re-rating that's coming as these companies report earning with much higher metal price. This looks like it's going parabolic. And if silver goes to that $130 level I mentioned, these miners are going to go absolutely ballistic. Let me talk about some other metals briefly. Copper's up 2%. Copper is Dr. Copper, they call it, because it's supposed to predict economic health. Copper is interesting right now because it's testing a major level. If it breaks through, great. If it gets rejected here, it could pull back hard. I'd probably wait for a correction for getting into copper miners. Uranium is up 4%. Uranium has been on a tear. And here's something interesting. The Physical Uranium Trust is actually trading at a premium. What that means is if you want to buy uranium through this fund, you're paying more than the spot price of uranium. Usually when that happens, when something trades at a premium like that, it's a sign that maybe you should think about taking some profits. It's kind of a contrarian indicator. When retail is so excited, they're willing to pay a premium, that's often near a top, at least a short-term top. Uranium miners are up over 9%, cooking along at all-time highs. This looks fantastic, but I'd probably be trimming into strength here pretty soon. These markets are very cyclical. You buy them when they're hated and cheap. You sell them when they're expensive. Everyone loves it. Oil is up about 3%. Oil is forming what looks like a bullish pattern. It broke above certain levels and is consolidating. Next major level is around $62. If we get a weekly close above that, I think we've seen the floor in oil. But I think we might see a little weakness in oil and oil stocks over the next few weeks. That'll allow some of these gold and silver bets to mature, and then we can rotate capital into select oil. Natural gas just went absolutely vertical, up 70% recently. That's why I don't trade natural gas. It's too volatile. It'll rip your face off. But natural gas stocks are only up about 3.5%, so they're lagging the commodity itself. Platinum's up 18% recently. Absolutely fantastic move. Next target's probably around 3,300 to 3,400. Palladium's up over 11%. Also looks like it's going higher. The Bloomberg Commodities Index is up over 5%. That's a broad basket of commodities, and it's absolutely ripping. When you see the commodity index moving like that, it's telling you something. It's telling you that real assets are being bid up. It's telling you that inflation is coming, or that people are worried about currency debasement, or both. Nickel's up 7%. Looks like it's finding a floor. Rare earth metals are up over 10%. All of these industrial and precious metals are moving higher. That's not a coincidence. That's a statement about what people think is coming. I want to show you something really important that puts all this in perspective. If you look at the price of the average US home priced in ounces of gold going back to 1975, you can see some really extreme moves. Back in 1980, at the gold and silver peak, it took only 73 ounces of gold to buy the average US home. Then at the dot-com bubble, it took 700 ounces. Then in 2011, it took 116 ounces. A few years ago, 273 ounces. Today, it takes 82 ounces. So homes priced in gold are only 30% of the cost they were just 3 years ago. That means homes are 70% cheaper when you measure them in gold. Everyone thinks homes are expensive, but they're actually cheap when you measure them in what actually holds value. And if you look at silver, it's even more dramatic. 3 years ago, it cost 25,000 ounces of silver to buy the average US home. Today, it costs about 4,000. That means homes priced in silver are only 16% of what they cost 3 years ago. That's an 84% discount. What does that tell you? It tells you that gold and silver have been massively outperforming real estate. It tells you that precious metals are repricing against everything else in the economy. It tells you that we're in the middle of a major shift in what holds value. And here's another interesting: copper divided by gold. When you look at that ratio, copper's way down the bottom of its historical range. That probably means copper is going to start outperforming gold at some point. These ratios tend to mean revert over time. What does all this mean? Why am I talking about all this? Because this is about understanding where we are in the cycle. This is about understanding that when the world's reserve currency starts breaking down, when trust in sovereign debt starts eroding, capital flows to hard assets. We're seeing it happen in real time. Gold breaking to new highs, almost at $5,000. Silver absolutely screaming higher, over $100. Precious metal miners starting to catch up. Commodities across the board moving higher. This is not just about inflation. This is about a fundamental shift in how global capital views safety and store of value. This is about the dollar losing its grip. Let me bring this back to crypto for a second, because this is important for the longer term picture. Crypto, and Ethereum in particular, stands alone as the only asset class that combines true sovereign-less neutrality, real yield through protocol mechanics, and growth driven by network adoption. Even gold and silver, as great as they are physically constrained. They're expensive to transport. They're vulnerable to government seizure, export controls, capital restrictions. If a government doesn't want gold leaving the country, they can stop it. They've done it before. But crypto can't be stopped that way. It's digital. It's borderless. It doesn't care about customs, about borders, about governments. Political leaders may talk about fiscal discipline, monetary stability, but the reality is we're going in the opposite direction. In a world of geopolitical competition, demographic pressures, massive spending, deficits, and monetary expansion seem unavoidable. Ethereum specifically offers something fundamentally different. It enables global capital to move outside political pressure. It transparently reflects monetary conditions, and it provides yield through the most secure, liquid, programmable financial network ever created. As tokenization grows, as stablecoins expand, as decentralized finance infrastructure develops, Ethereum's role as a settlement layer for the global economy becomes more embedded. That creates structural demand. In a world of rising geopolitical risk, deteriorating sovereign balance sheets, and eroding trust in fiat, crypto, and especially Ethereum, could be repriced entirely from a speculative asset into a sovereignless, yield-bearing, global safe haven instrument. This dynamic is not theoretical. We've already seen it in emerging markets, where crypto adoption has served as a hedge against capital controls, currency debasement, and political instability. In those countries, crypto is not speculation, it's financial survival. Now, imagine that expanding from emerging markets to the entire global system. As tensions between the US and the rest of the world intensify, as monetary debasement accelerates, as we potentially move into a sovereign debt crisis, gold and silver have already repriced violently. They're signaling a profound shift in capital allocation and trust. While crypto investors have been forecasting this for years, this is the first time the West is being forced to confront it and its speed. Unlike emerging markets where monetary instability is cyclical and expected, the West has operated under the assumption of permanent financial credibility. That assumption is now being challenged. If the scale of the US monetary system, the vast network of dollar-denominated trade and reserves, if all of that begins to fundamentally question the integrity of the system, the resulting capital flows could be historic. It would be a regime change. There may still be time to stabilize and rebalance, but doing so will be extraordinarily complex, politically constrained, and structurally difficult. In other words, I'm not holding my breath. So how do you prepare for all this? In the near term, smart defensive plays make sense. High dividend paying stocks where PE ratios are reasonable. Staples. Things people have to buy no matter what. In recessions and depression, people still have to eat. They just can't buy the expensive stuff. So they go to cheaper alternatives. But longer term, you've got to be aware of what's coming and start positioning gold, silver, select miners, and yes, longer term, crypto assets like Bitcoin and Ethereum that offer true alternatives to the fiat system. Timing is hard. Timing is the hardest thing in the world, even for professionals. But the direction is clear. When the world reserve currency breaks down, when sovereign debt becomes questionable. When trust erodes, capital flows to hard assets and sovereignless alternatives. Let me be clear about the risks because I want you to understand what you're getting in. Precious metals can be volatile, miners even more so. There's execution risk with mining companies. There's geopolitical risk. There's the risk that the central banks try to suppress prices, which they've done before. With crypto, there's regulatory risk. There's technology risk. There's the risk that institutional adoption doesn't happen as fast as expected. And there's always the risk that I'm wrong about time. Maybe this plays out over 10 years instead of 5. Maybe there's a period where the dollar stabilizes. All these assets correct hard. You need to understand these risks. You need to size your positions appropriately. You need to have a plan. This is not put everything you own into gold and silver and crypto. This is about intelligent allocation based on understanding what's happening. But if you look at the evidence, if you look at what's happening with the dollar, if you look at what's happening with sovereign debt, if you look at what's happening with trust in the global financial system, the case is mounting. We're in the early stages of a major shift. The people who position correctly are going to preserve and grow their wealth. The people who ignore it and stay in depreciating fiat and bonds are going to watch their purchasing power evaporate. So what's the bottom line? Trump has reset your money, whether intentionally or not. The dollar's breaking down. The support levels that have held for over a decade are being tested. When that breaks completely, when we go below 95, below 90 on the dollar index, you're going to see accelerated capital flows out of dollars and into hard assets. Gold is already knocking on the door of 5,000 and looks like it's going higher, potentially to $5,400 and beyond. Silver's over $100 with targets around 130. Miners are starting to catch up as the re-rating happens. Commodities across the board are moving. And longer term, crypto assets that offer true alternatives to the fiat system are going to be repriced from speculative to safe haven, just like we're seeing happen with gold and silver, right? This is not speculation. This is not hype. This is reading what's happening in the world, understanding the policy decisions being made, and positioning accordingly. I'm not a financial advisor. This isn't financial advice. You need to do your own research. You need to make your own decisions based on your own situation. But if you're looking at the setup, if you're looking at what just happened with the dollar, if you're looking at what's happening with gold and silver, if you're understanding the longer term thesis, this deserves serious attention. Smart money is positioning now before these trends fully accelerate. Don't be the person who watches from the sidelines while the monetary system shifts underneath. If you want access to our daily analysis and research, you can try our premium community for just $25 for 7 days at stockscommunity.com. Plus, if you want the full transcript of this video and others like it, sign up for our free newsletter at free.stockscommunity.com. The link is in the description below. Head over to stockscommunity.com to get a free trial of our Trade of the Day service, where I pick the best stock idea to buy now each day. Not financial advice, of course. But what are your thoughts on it? What are you positioning for? Are you seeing what I'm seeing? Let me know in the comments. But that caps off today's video. If you found this valuable, smash that like button, subscribe to the channel, share this with somebody who needs to understand what's happening, because the window is closing. The shift is happening now, and the people who position correctly are going to come out way ahead. But that caps off today's video. If you found this valuable, smash that like button, hit the subscribe, and hit that share button. The opportunity is now, and the people who position correctly are going to make life-changing return 2026.